The money supply, a fundamental metric in macroeconomics, quantifies the total volume of money available in an economy, shaping inflation, interest rates, and economic growth. In the United States, the Federal Reserve categorizes the money supply into monetary aggregates, M0, M1, M2, M3, MZM, and L, each reflecting varying degrees of liquidity. The M stands for money, denoting assets ranging from physical cash to less liquid savings. As of January 2025, M1 is approximately $18.1 trillion, and M2 is $21.97 trillion, capturing liquid assets driving economic activity. These aggregates exclude certain financial instruments, such as precious metals, bonds, property, cars, and consumables, which represent wealth but lack the liquidity to function as money. Historically, M1 and M2 have grown significantly, with notable surges during crises like the 2008 financial crisis and the 2020 COVID-19 pandemic, driven by policy interventions. Understanding these aggregates, their exclusions, and their relationship to assets like precious metals and tangible goods is critical for assessing economic dynamics, guiding monetary policy, and informing investment strategies. This article defines M1, M2, and other aggregates, details their current and historical values, explains exclusions and their rationale, examines the role of precious metals and other assets, and underscores the importance of these measures in economic analysis. Definitions and components of monetary aggregates. The M in monetary aggregates stands for money, representing categories of financial assets based on their liquidity and use in transactions. The Federal Reserve defines these aggregates to track money's role in the economy. M0, monetary base M0 includes physical currency, Federal Reserve notes and coins, in circulation outside the U.S. Treasury, Federal Reserve banks, and bank vaults, plus reserves held by depository institutions at the Federal Reserve. It forms the foundation of the money supply. M1 encompasses the most liquid assets used for transactions, including currency in circulation, demand deposits, checking accounts at commercial banks, excluding those held by the government, foreign banks, or other institutions, and other liquid deposits, negotiable order of withdrawal, NOW, accounts, automatic transfer service, ATS, accounts, share draft accounts at credit unions, and, since May 2020, savings deposits due to regulatory changes in Regulation D. M2 includes M1 plus less liquid assets, such as small denomination time deposits, certificates of deposit under $100,000, excluding IRA and KEO balances, and retail money market mutual funds, MMFs, excluding IRA and KEO balances. Before May 2020, M2 included savings deposits, now part of M1. M3, discontinued by the Federal Reserve in 2006, M3 included M2 plus large time deposits, over $100,000, institutional MMFs, repurchase agreements, and Eurodollars held by U.S. residents at foreign bank branches. It captured broader institutional funds. MZM, Money Zero Maturity MZM includes M1 plus money market accounts and other assets redeemable at par on demand, excluding time deposits. It emphasizes immediate liquidity. L, the broadest measure, discontinued in 1996, L included M3 plus other liquid assets like bankers' acceptances and certain securities. These aggregates form a spectrum, with M0 as the narrowest and L as the broadest, each reflecting different economic functions. Exclusions from M1, M2, and other aggregates. Monetary aggregates focus on liquid assets used as a medium of exchange or store of value, excluding certain financial instruments and tangible assets due to their lack of liquidity or transactional utility. What M1 excludes? M1 excludes savings deposits, pre-2020, time deposits, money market funds, bonds, stocks, precious metals, property, cars, and consumables. These assets are not immediately spendable or lack the liquidity of checking accounts and currency. For example, bonds require sale to convert to cash, and property involves lengthy transactions, making them unsuitable for M1's focus on transactional money. What M2 excludes? M2 excludes large time deposits, over $100,000, institutional MMFs, repurchase agreements, Eurodollars, bonds, stocks, precious metals, property, cars, and consumables. These are less liquid than M2's components or not held primarily by households, as M2 focuses on retail-oriented, near-liquid assets. What M3, MZM, and L exclude? M3 included broader institutional assets but excluded non-financial assets like property and precious metals. MZM excludes time deposits requiring maturity, while L, though the broadest, still omitted illiquid assets like real estate. All aggregates exclude non-financial assets and illiquid financial instruments. Why exclusions occur? Aggregates prioritize assets used for transactions or easily convertible to cash. Precious metals, while valuable, require market transactions to become spendable. Property and cars, as tangible assets, are illiquid and not used as a medium of exchange. Consumables, food, clothing, are goods, not money, and lack store of value or exchange functions. Excluding these ensures aggregates reflect money's economic role, not wealth or investment value. Current and historical values of monetary aggregates. As of January 2025, M1 is approximately $18.1 trillion, comprising $2.37 trillion in currency and the rest in demand deposits and other liquid deposits, including savings deposits reclassified after the 2020 Regulation D change, which removed the 6 transaction limit on savings accounts. M2, at $21.97 trillion, includes M1 plus $3.87 trillion in small denomination time deposits and retail MMFs, reflecting broader liquidity. Historically, M1 and M2 have grown significantly since 1959, when M2 was $286.6 billion. By January 2000, M1 was $1.1 trillion, and M2 was $4.7 trillion. The 2008 financial crisis prompted quantitative easing, pushing M2 to $8.5 trillion by 2010. The 2020 COVID-19 pandemic caused a dramatic surge, with M1 rising from $4 trillion in February 2020 to $16.3 trillion by May 2020 due to savings deposit reclassification, and M2 jumping from $15.3 trillion to $18 trillion by June 2020, peaking at $21.72 trillion in April 2022. Since 2022, M2 growth has slowed, dipping to $20.86 trillion in 2023 due to tighter monetary policy. M3, tracked until 2006, reached $10.2 trillion, including institutional funds. MZM mirrors M2 trends, emphasizing liquid assets. L, discontinued in 1996, provided minimal additional insight. M0, embedded in M1 and M2, includes $2.37 trillion in currency and reserves. Surges during crises, 2001, 2008, 2020, reflect Federal Reserve actions like lowering interest rates or asset purchases, highlighting the money supply's responsiveness to economic conditions. Role of precious metals and other assets. Precious metals, such as gold and silver, are excluded from M1, M2, and other aggregates because they are not legal tender in the modern U.S. economy and lack immediate liquidity. Historically, gold backed currency under the gold standard, pre-1971. But today, it functions as a commodity or investment, requiring sale to convert to cash. For example, a gold bar worth $100,000 cannot be used directly for transactions like a checking account deposit. The Federal Reserve does not include precious metals in aggregates, as they are not part of the fiat money system, though they serve as a store of value and inflation hedge. Their market-driven value and illiquidity exclude them from money supply metrics. Tangible assets like property, houses and cars, and consumables, food and electronics, are also excluded. Property and cars represent wealth but require time-consuming sales to become spendable, disqualifying them from M1 and M2's focus on transactional and near-liquid assets. Consumables lack store of value or exchange functions, as they are used or depreciate rapidly. These assets influence the economy indirectly. A house purchase via a $100,000 loan creates a deposit, expanding M1, but their value is not counted in aggregates. Instead, they are collateral or consumption goods, impacting loan demand and economic activity without being money. The exclusion ensures aggregates measure money's role as a medium of exchange, not broader wealth. Importance of M1 and M2. M1 and M2 are critical for understanding economic dynamics and shaping monetary policy. M1, capturing currency and demand deposits, reflects immediate purchasing power, driving consumer spending and retail activity. M2, including savings and time deposits, indicates broader liquidity, signaling potential spending or investment. Economists monitor M2 to forecast inflation, as its growth often precedes price increases, with an 18-month lag observed during the 2020 to 2022 period when M2 surged and inflation peaked in June 2022. The Federal Reserve uses M1 and M2 to evaluate monetary policy, such as adjusting the federal funds rate or conducting open market operations. Rapid M1 or M2 growth signals inflationary risks, prompting tighter policy, while contraction may indicate recessionary pressures, necessitating stimulus. Investors track these aggregates to predict market trends, as money supply growth can boost asset prices, stocks, real estate, or signal inflation risks affecting bonds. Historically, monetarist theories linked money supply to GDP and inflation, though recent data shows weaker correlations, reducing M1's prominence. M2 remains a key indicator of economic health, guiding central bank actions and investment strategies. Exclusions like precious metals and property ensure aggregates focus on liquidity, not wealth, clarifying their role in economic analysis. Conclusion: M1 and M2, at $18.1 trillion and $21.97 trillion in January 2025, respectively, are pivotal measures of the U.S. money supply, capturing liquid and near-liquid assets essential for economic transactions and savings. M1 includes currency, demand deposits, and other liquid deposits, while M2 adds small denomination time deposits and retail MMFs. Other aggregates, M0, M3, MZM, and L, offer additional perspectives, though M3 and L are discontinued. Exclusions like precious metals, property, cars, and consumables reflect their illiquidity and non-monetary role, ensuring aggregates focus on transactional money. Historical data shows M2 growing from $286.6 billion in 1959 to $21.72 trillion in 2022, driven by crises and policy actions. M1 and M2 guide Federal Reserve policy, influence inflation forecasts, and inform investment decisions. Precious metals, once currency backers, and tangible assets like property shape economic activity indirectly through loans but remain outside aggregates due to their lack of immediate spendability. Monitoring M1 and M2 is crucial for understanding liquidity, stabilizing economies, and navigating financial markets, highlighting their enduring significance in a complex, debt-driven financial system.
Okay.